Good morning, everybody. Welcome to the Flow Show. Before we start, I would like to say that one of our jobs here is to inspire traders, inspire people to get into trading. And it seems to have worked in a sort of way, because one of our roomies, I won't mention him, if you're in the chat room you'll know, has been so inspired by what me and Kay and everyone else does that he had a dream of me and Kay having a cage fight the other night. Kay, what do you make of that?
I mean, he was honest enough to say that there was a lot of alcohol involved before he had his dream. But I'm a pacifist. Yeah. I'm a pacifist, mate, and I couldn't even pull your hair because you don't have any.
I wouldn't even be able to climb in the cage. So, yeah, I've got to be the strangest. I don't know if I call it a compliment or not I've had in this business, but anyway, inspiring we are apparently, and yeah, I want some of whatever he's been drinking. Anyway, moving on from that, I'm a bit taken aback by that conversation. But
I think we can leave it there for the show today.
Yeah. You know what? I'm going to have a dream about it tonight as well. It's one of those subliminal things that's going to happen. Brilliant. Okay, right. Well, let's try and get on with the rest of the show. Yeah.
He's still not around today.
I don't think so.
Ah, okay. Because I might need to jump off the call because I'm of the show at some stage, because I'm expecting a phone call, so I'll let you know when my phone rings.
Yeah, just let me know. I think he's off picking up his daughter from summer camp, which is about a 7-hour round trip or something.
Oh yeah.
But yeah, just let me know and I'll see. Yeah, I'm sure I can manage. We'll put on some cartoons or something, some old cage fight videos. Right. Oh, I'm off my stride now after all that. China state media was out saying that China's FX market is stable and cross-border flows are basically balanced. This is another part of the yuan story, particularly with banks lowering their dollar deposit rates that they were paying down to 2.8%. It could lead to flights out of China, mainland China, offshore. So they have got capital controls already in place, although plenty of people find ways to circumvent those. But if people in China have dollar deposits, obviously with interest rates in the US as high as they are, and you can only get 2.8% in China, you might be inclined to take your dollars elsewhere to get a better rate. But they're saying that cross-border flows are basically balanced, so nothing so far to show from that to say that anyone's moving dollars out of China. They also say they have ample policy tools to stabilize the FX market. And another PBOC paper said that the factors are rising for yuan stabilization and appreciation. And that was a PBOC paper again. Rather than directly from the PBOC. For dollar China, a quick look, and I'll look at it in more detail later on. We are still holding up fairly well. We had this move down the other day. That hasn't lasted. We're back up again. Things are looking more settled, but definitely we're not seeing any real major push to the downside yet in this pair. So for now, still keeps the trend as your friend. The RBA is expected to unpause in August and raise its rate to 4.35%. That's according to 23 out of 25 economists polled by Reuters. The other two said they will pause. So their wait and see rhetoric isn't going down well with economists who think it's on off, on off, on off as far as rate hikes are concerned. Over in the UK, and we're going to get another change on the MPC with a woman called Sarah Breeden being put up potentially as the Deputy Governor of the Bank of England when the current incumbent Cunliffe is set to leave in October. She's already at the BOE as Executive Director of Financial Stability, Strategy and Risk, so very well known there. There are a few other names in the hat as well, including her former boss or person who was in her role previously. So that's happening in October, when we're going to lose Cunliffe, and she's likely potentially going to replace him. BOE's Bailey has been doing the news rounds this morning, saying there is evidence some retailers are overcharging customers. A bit of a no shit Sherlock comment there. He says that moves by regulators on retail prices, especially in the fuel market, will help lower inflation. That's good, because I need to fill my car up tonight. He says, I expect quite a marked fall in inflation, but it will still be hard for borrowers. And asked about when rates will come down, says, I can't give you a date for when they start to come down. Over on the pricing front, and yesterday, the market, or some aspects of the market, were putting as a 1 in 2 chance of a 6.5% rate top for the UK. And then this morning, apparently other traders have fully priced the rate hike peaking at 6.5% by March. JP Morgan were out with a piece also where in a certain scenario, they see the BOE rate getting to 7%. Current probabilities at the moment have flipped a bit. We're now pricing a 50 pip hike at the next meeting as 62% chance, with 25 pips as the balance, 38%. As I've been saying for a while, I think these expectations are getting very extreme now. I mean, even throwing 7% into the conversation, I think is getting a bit silly. We're not wholly seeing the pound react, although it is a bit more bid today. UK yields on Bailey and the comments really looking quite high still. As you can see, they're moving higher. We've had some 2-year auctions, which again have been very toppy in terms of the rates they've been set at. So there's no let up at the moment. The market is still expecting higher rates. The 2 years are getting up to around about the area where I expect, and the majority of the market now expects rates to go, somewhere around 5.5%. So much like we were watching US twos for that rough guide of where rates are going to go, now we need to be watching UK twos a bit more closely, I think, from now on. But I think 6.5%, 7%, that really is getting to silly levels. Although I wouldn't rule it out, especially being the BOE in UK and the way things work with inflation over here. If there's one bank that's probably got a higher chance of getting there or having to go there, it's going to be the Bank of England over a lot of the others. But I still think it's a very low probability. What are you making of the UK moves this morning, Kay?
Yeah, you know, there's always this thing, and we've been trading interest rates for so long now after the pandemic, and this a currency will always follow yields for so long, right? If it would be for the right reasons, that there is growth and everything is going well in the UK, and inflation stays high, and then they raise rates, or the expectations on rates remain high, then the currency would probably fly. Now it seems that the market starts to think it's for the wrong reasons, so sterling isn't following. Now it's going to go in steps, right? If the economic data really hold up in the UK, and the Bank of England is forced to raise further, then probably the sterling will do another leg higher. But I think now the market is taking a pause and seeing why the BOE would need to raise rates, and if not getting stronger, it's probably going to prevent the sterling from falling out of bed. But what it will probably do is increase volatility.
Yeah,
we could see a bit sharper moves. You know, if you get like a Bank of England that needs to raise rates into an economy that remains very sluggish, let's call it not even a recession, but around zero, you're probably going to see an increased volatility in the sterling. There's going to be moves based on yields, and then moves based on real economic data. And we also have to say that Bailey is still in his still trying to convince people that inflation is going to come off, but he has been so wrong. And also the way he brings it is over is actually not very not very encouraging to be long sterling for the longer term. But as I say, I think it's more going to add to the volatility and keeping sterling from going down much, probably. That's how I look at it right now. And I think, and honestly, I think 7% is probably going to cost Bailey's job if he has to go over there. And he might even not survive it himself mentally. But yeah, I think JP Morgan is trying to call the odd one out, or their very very long yields, very short UK bonds perhaps. But
yeah,
I kind of agree with what we were talking about yesterday in the Flowonomics room, with Magix and James, yourself, myself. Is that if you see a decent price 1 year out from now, in 3 months, or in the 3 months, or the 6 months, or perhaps even a little bit longer, if you see anything above 6.5%, I think it's pretty cool to try and get some on board of those futures also.
Yeah, we were looking at Sonia rate futures,
yeah,
which you can get on certain brokers. I know our man Magix is already dipping in. I think James was looking too, but I agree. It's not the fact that cable's shooting higher on these higher expectations. It's more the fact, like you say, it's not going down. And I think, pricing wise, I think there's probably a few in the market who are thinking, okay, yeah, getting to 6% is going to be extreme. I'm not going to rule out a further move up in the pound. I mean, we can already start to see it in euro sterling, which is under a bit of pressure again, heading back towards those lows perhaps. That's probably this morning and the last couple of days bit of rate divergence trading there in this increased hawkishness for the BOE. But I think if we get rates up to 5.5%, if the pound's still looking strong there, that's when I'm going to be potentially looking for shorts, because I think that it will two things. I think the clock, as I said, is on the BOE side in when inflation starts coming down, and I think the higher they go, the more pain it's going to cause the UK. The bigger the downturn might be, that's obviously less positive for the pound, or very negative for the pound. So I think if we get rates to 5.5%, I'm going to be looking at the pound closely for shorts. And if that's whether that's euro sterling down 85s or better, that's where I'll look. That's often the safest place to try and play a pound trade. But cable could be one as well. Up at 130, I may be tempted just on a move up there anyway, from a tech standpoint and a level standpoint. But yeah, I think we're getting closer to the point where I'm going to seriously consider taking a longer term pound short on that. Mike's is asking about the construction PMI this morning. Again, we've been saying this about the data. The market knows that there's going to be economic weakness. It's just the level of economic weakness that's going to matter. And as we've just been saying, there's a bit of a balance between watching the data and what the market is expecting for the bank, for the central bank. The construction PMI isn't a huge number, and all the Eurozone numbers are still in contraction as well. So probably better to look at that from a global economic perspective, what's happening globally. The same, as I say, the same as in the Eurozone, they were all still in negative territory. So that's now 3 sectors, 2 in negatives and 1 that's in positive but falling, i.e. services. And we get the next one from the US today. So you have to look at that from a global perspective. And then it's back to the old, who's got the least dirty shirt in the laundry basket. Right, anyway, moving on. SMB's Makler says the SMB doesn't rule out further rate hikes. So door left open there. Coming over to the data, and just to show you there's all the construction PMIs coming in. Some were a bit of an improvement, like in Italy, Germany worse. France was a bit better. Eurozone overall was worse. There's the move in the UK into contraction. Was expected just to fall back a little bit. There has been some good news for Germany. Woohoo! Factory orders in May rose 6.4%. A bit of a bounce there, only 1.2% expected. I haven't looked into the data to see if there was any particular skew in that, but the rest, seeing as the rest of the data has been pretty poor, it may be there's some sort of one-off factor in that number, but positive it is nonetheless. FOMC minutes were out last night as well, and really just pushed the hawkish rhetoric that we've already been hearing. Almost all members saw a pause as appropriate or acceptable. Some favoured a rate hike but went along with a pause. Almost all officials expected more rate hikes in 2023. The ones who did favour hiking noted that the labour market was still very tight. There was stronger than anticipated economic momentum, and little evidence of inflation being on a path to return to 2% target over time. Now, again, there's been a bit of a pickup in the rate expectations for the next meeting, the July meeting. We're now pricing 87% probability of a 25 pip hike. The balance 13% of leaving rates unchanged. That was running at about 65% previously, so that's ticked up after the minutes. Feds Williams has been out saying that I'm not content with where inflation is right now. Fighting inflation remains the Fed's main job. Sees progress on inflation, but price pressures are still too high. May take a year or two to feel the peak effect of monetary policy. That's it from me from the headlines, unless the K-Man has got anything he wants to add to that.
No, I don't think so. Just that Yellen has landed in China, so we should have headlines coming up any time, really, including over the weekend, because she's apparently staying until the 9th, which is Saturday at least included. So,
What's she? She's not likely to talk about trade and stuff, is she? It's all going to be treasury related stuff. Monetary stuff, you think?
Yeah, but you know, Yellen, I don't know. She likes to get involved in stuff that the treasury that's not strictly treasury related. So I guess we are going to hear a bit more. I'm not even sure. I haven't seen her schedule. I'm not even sure who's she going to talk to. But the more official it gets, the more there could be a headline on relationships and stuff. So
yeah, that's what we need to look for.
For the rest, no, not really seeing much. No, wait, go on.
Cool. Okie doke. Rick's just asking a question. Was any news on the BOJ with the dollar-yen drop this morning? That was a bit of a strange one. It was quite a significant move. There was a story out with from Daiwa commenting that apparently there's some ETF managers who are having to shell out some dividends shortly. So to do that, they are going to be selling cash stocks and futures to the tune of around 1.16 trillion yen, which is about $8 billion, to pay out those dividends. Now, we've been sort of scratching our heads in the room as to what the FX impact would be. I'm still struggling to draw a one-to-one linear reason for that. The Nikkei dropped back this morning, as we can see there, but it's pretty much been falling all week. So it could be related, it might not be related. We're not sure. That's the reasoning people are putting forward, that headline why it dropped. But as you can see, the Nikkei's been dropping all week and dollar yen wasn't until today. As Kay mentioned in the room, it might just have been a bit of a straw that broke the camel's back sort of thing, and that's why we got the break. It has bounced back up, and as you know, I was saying yesterday, we were sitting in this tight range, 144, 145. Something had to give. I was positioned if it gave to the upside. Instead, it gave to the downside. So we had a break, it accelerated through, but now we're back above. What I would say is a bit like euro dollar yesterday at 109, we had a big option expiry, 2.75 billion, that kept the price glued there. We've got just over 2.4 billion expiring at 144 today in dollar yen. So I'm not surprised to see it back up near the big figure. We could see the same glue effect coming in there. The only difference between today and yesterday is we've got a lot of data out today. So that is going to have an impact more so possibly than the expiry. But I wouldn't be surprised if we see us sticking around this 144 until the big data starts dropping off. Asking if I'm still looking for 147.
I need to jump for 5 minutes, Ryan.
Yeah, go, mate. Yeah, carry on. Do I still see it going to 147? My basis for that isn't anything fundamental. It's more of price action. If we break 145, which as we can see now has become a bit of a level for quite a period now, if we get a break, it's likely to accelerate through. We know there's a huge number of reasons why we're here at 145. It was a big tech level on the way up. It's been a big tech level on the way down. It's just coming there, so you can see that a bit clearly. And we're seeing action again here in this period, in this last couple of weeks. So it's a big level. It's also been a big level for the market thinking that that's where the MOF are going to intervene. So there's all sorts going on. There's probably people front running it, hence why it's such a solid level. They want to be in short dollar yen in case the MOF jump in, and they hope to profit from that. So all the reasons why we should be below are pretty strong. Hence why if we break, it's likely to be explosive. And if so, I think 147 is well within reach pretty quickly after that goes. Because anyone who's front running here going to have their stops right above. And if there's enough of them, it's going to cause a big move through. I wouldn't be surprised if we were at 146 in a blink. So that's my basis for thinking how we would get to 147. It's not anything nothing to do with the fundamentals or anything like that. Obviously, if we get really strong data from the US, it might be a foregone conclusion anyway. And that's why also I'm trading, or going to try and trade, a break of 145. I'm more confident in that than I was saying about a break in 144, because I thought if we get a break in 144, yeah, it may push through quite a bit, but there's going to be dip buyers coming in. And that's exactly what happened. You know, we only nearly got down to 143.5. I said that might be the place where the dip buyers will come in, and they duly have done. So the trend is still in play for this one. Okay, the dip buyers are going to be coming in because there's still rate differentials between the US and Japan. Japan is still in easy mode. The Fed is still in hiking mode. That's going to keep this trend in play until something different comes along. So that's my reasoning. And I'm, as I say, going to play a break, or try and play a break of 145 with some buy stops and see where it goes from there. Yeah, Ali, I've just answered that to Rick, so I hope you've got that there. Right, just looking at some of the other pairs going around. So euro dollar, here we go in this zone of mine. Had a move down to the bottom end 30s, it's held again. Now we've bounced, but we're not getting back above the 70s. So a little bit of indecision what's going on here. I did have a little play of the option into the expiry yesterday, that big expiry, because we were seeing cable moving up and dollar yen coming down, general dollar selling going on. But while cable was moving up to 127.35, making new highs, euro dollar was stuck at that 109. So I went long at 87. I thought after the expiry, if that situation was still in play, maybe euro dollar would catch up and rally a bit. However, that didn't happen. It turned. I scratched it for a couple of pips loss. No harm, no foul. And that was a wise move, because that's when we headed all the way down to 108.30 thereafter. So could be a similar thing with dollar yen today at 144. But for the euro at the moment, still ranging. While we're above 108, again, it keeps this move in play. We had this bigger trend, a bit more sideways going on, a bit more up and down, but we still got the levels in place. So 108 is my key area for this. This is like the 144 in dollar yen, and 110 at the moment is sort of like the 145 in dollar yen. So we're stuck in this range. If we get a move outside of that, that's when something may happen. So it's going to take a break of either side. If you're trading more short term, fine. You know, you can tinker around in here. Got these levels in play. 108, 30, 70. That's 40 pips for you to scalp away in for you scalpers. 109 now is now a bit more of a level after we've had several attempts to get through and couldn't. So it could mean this 110 might start stepping down and the protection starts there. So the longer we stay below 109, the greater the chance we're going to get a move down to 108. So the levels are developing, and if you start to get resistance here, fine. Be wary that if you get a break, then maybe we're going to have a little shoot higher. So it's all about how the price action develops for me before I start to think about trading a level. Down here, I would maybe consider trying to break short, but because we've got that big 108 just below it, there's not enough room in there for me anyway to play around in trying to short, thinking we're going to get a move through 108. That's going to be the sticky area. However, if you get a break of 108 and it holds as resistance, then we're probably on for a bit more, maybe even a move down to 107.
I'm back.
Just look, oh, he's back. He's back. Euro sterling, keeping an eye on as well, because we may, as I said, may be heading down a bit lower. Just seeing a bit of a bounce coming in now for lows, but we've had this move back down, and now it's holding under the various levels. This 85.50 isn't a huge level. It's one of those just watch areas that I've got on my chart, but at the moment it's now resisting for 3 attempts. So that suggests we are on for some downside. Again, I've been banging on about potentially trying along down here. Let's go there into this 85 area. I'm still interested, but I'm going to be closely monitoring why we're going down here. If it's on the back of economic weakness, if it's on the back of higher Bank of England forecasts or rate expectations, I might be a little bit more cautious about trying along. I still like it from a technical standpoint, but if the fundamentals are changing, then I'm going to be a bit more wary about that one. But we shall see. We're not there yet, and we've got some way to go. As mentioned with dollar China, still doing what it needs to do. It's a bit undecided what it wants to do now. We did get it back above 120. I keep calling it 724.5, 725. So we're holding that area for now. I think I want to see a bit more confirmation off this area as support. If we get that, then I think we're probably going to have a look at the highs again. It's going to be important where we get to. If we only pull up to, maybe mid to high 727s, we don't quite reach that high, and then we pull back again, that's going to tell me we are developing a bit more of a stronger top up here. If we go up, even if we make a slightly higher high, 729 for example, that will tell me that we're still willing to push higher, and maybe we'll get another leg up. But for now, it's all about the price action and what happens if we get another test of the high. If we come up short, then I may think about trying a separate short trade, because I think then we may see a steeper pullback. But the levels, the techs are playing nicely for now, so I'm still long a little bit and happy to stay on that side. Ali, let's have a quick look at cable. Dojis, no interest in Dojis, not in my playbook at all. What I just look at is the price action, and as we've been saying, we're stuck now 126, 128. 127s is proving to be a bit of a pivot area at the moment. A bit like a lot of the pairs we're talking about, we've got these pretty tight ranges, you know, 200, 250 pips in cable, 126, 128 and a half. You know, it's a tight range. We haven't had such a tight range developing for maybe a couple of months. So you've got to pay attention to it. We're not looking like we're going much higher, but we still remain supportive. So if you want to trade it, you don't need a bias for this. If we break 128 and a half, we're going higher. If we break 126, we're going down. All you've got to judge is how far you think the trade is going to go either side before it then runs into trouble. If you break 126, 125 and a half is a level. So maybe you've got 50 pips to play with to take some profit, see what happens after that. If we can't get through there, we're probably going back up again. So, you know, as I say, you don't need a bias all the time for trading. You don't need to think pounds going up, pounds going down, UK's this, UK's that. Sometimes all you need is two lines, two levels to trade. It's either going to hold it or it's going to break it. And it's what you do at those lines that matter. Take the thinking out of trading, just go with what happens. You're not convinced there's upside momentum. No, I'm not overly convinced either. There are recession fears in the UK. The data is not strong. There's recession fears in nearly every European country. There's recession fears in the US. There's recession fears in China. There's not many places there aren't recession fears. So if everyone's thinking about recession, which currency is going to weaken the most? You know, that's the game you have to play. So you may be bearish on the UK, that's fine. But if the UK isn't as negative as the Eurozone, then you're going to see the pound perform better than the euro. So that doesn't play into your sentiment. So it's okay to have a bias, but when you come to push the button, trade the levels, trade the price action. And if you want to trade with your bias, fine. At least know how to manage that risk when you do. Kay, you all back and set?
Yeah.
You want to grab the old chart?
Yeah.
I did China, euro, dollar yen.
Yeah, the dollar yen. I was looking at this dollar yen and the yen pairs when they hit their low is right on the close of Tokyo today. I'm just going to show this just for a sec. If you look at the dollar yen, the 5 minutes, you look at, okay, the dollar yen perhaps a little later, but if you look at the euro yen, hit exactly the low on the close of Tokyo. So there's definitely been some flows in Japanese, in the Japanese time zone, and look at this. This is the Tokyo close, and it hit the low right there. Okay. Yeah. So you did the dollar yen already, and yesterday I did. I already showed a bit of this yen stuff. Euro yen still for me 155. As long as we're above, it's also a very long-term trend line coming in there. It's channel top. It's an extension level, whatever. 155 is your magic number on the euro yen. I think if it ever starts to go down, then there's something happening. Would it be in euro or on the yen side? So that's really a major level to look at. And on the dollar yen, I think 142.5 is showing up on the shorter time frames as well. But since Ryan did it already, I'm not going to repeat. All right, yields, because that is where it's going to get interesting today. We've seen this 10-year breaking this trend line, had one try above 386, then came back below. But I think this is decision time. We've got 2 days of important data, a load of jobs data coming in, ADP, Challenger, initial claims, and then tomorrow you add the NFP to that, of course. as we have been saying many times here, the labor market is one huge domino that refuses to fall right now. But if that would start to show signs of faltering that domino, then we're probably going to have a big setback in the US yields again. People will say, well, it will all depend how bad the numbers are, if they are. People are saying that it will underpin the stock markets because yields are going to go lower, and therefore the equity markets are going to jump higher. If it comes with bad economic data, the reason why yields are coming off, I would not be so sure. There's going to be an algo blip for sure, because you lower yields, everybody wants to pile into stocks. But if it's due to bad real economic data, I'm not so sure that it's going to be viable. So here also on the short end, we are constantly pushing against this this wedge top trend line. We are close to 5% again. If the US data are holding up, then I reckon this one is going to break above this 508, 510 prior high, and we're probably going to get closer to where the market will expect the Fed to, at least close to where the market expects the Fed to be going in the 2-year, in the short end, and the short end could actually push up another, I don't know, from here, why not another 50 BP, just repricing the Fed and getting very close to where they think the Fed may end up. 5.25 will already be a level, because that's where the Fed funds are, or the top of the Fed funds are now. So keep an eye on that. But if we would get bad numbers, and I'm saying bad numbers, okay, because it's not like if tomorrow the NFP, which is expected to come in at, where is it expected to come in at?
225, I think.
Yeah, 2.25, 225K. If you get 100, 150K, that's not a bad number. Yes, you will see a bit of a crack, and then you will see the equity markets probably rally on the back of it. But if by bad I mean zero, or get a review with a very negative number, get the unemployment rate, which is all of a sudden 4%, that's what I call a bad number. Okay. In that case, I think the equity market could just be a blip and then go back down. We are actually not too far from interesting levels here on the S&P. We are turning around this little bit of a trend line here. Some people have this where is it? It's a bit low. I had something in the low 43s there, 44s actually. Here, it's probably here. No, that's 43.65. But anyway, I mean, we are hanging around here. So get mild misses, which hint at a slowdown, but not the economy on a risk of really falling out of bed. Then we can push higher again, and why not going revisit prior tops around, or at least here around the 46 level? Why not in the S&P? Get a really bad one, I think we may have a little bit of a knee jerk, and then it's probably going to be end of the party, because the labor market is really one of the big dominoes, and everybody's seeing what's happening there, that it really continues to be stubborn and standing up. Okay, you have done the euro dollar. For me, as you say, Ryan, it's all about the 108. I think we've got 108.25, 30 here, but it's really, if the numbers hold up, then I think we're at least going to have a really good test. And seeing the sluggishness of the European data lately, I think there's a fair chance we break below there. We need to get back above 109.10, confirm it through 109.25 to get going again in the euro dollar. There's one that we need to keep an eye on here, and just because it's been behaving so strongly of late. This is the dollar rally that we saw, but then since then, since the start of the month, Kiwi is really teaching everything a lesson, and I've shown the Euro Kiwi already. It's finally starting to show a little bit of correction, but I think it's just the market managing, the players managing their positions into the slew of US data that are now upcoming. Again, depending on the US data, keep an eye on what's happening here around 61, 60, 65, and then here 61.40 on the Kiwi. But if the US data start to show misses, mild misses, because there's also an element of risk is a big word, but there's also an element of positivity or negativity in those commodity currencies and the antipodians, right? But if we get like just a mild miss, but which is still not showing that the economies are going to tank, this one is a candidate for retesting those recent highs, I think, just because the Kiwi is behaving pretty well. So that is perhaps $1 that I would look to play a little short if we get some misses in the US labor market. Just to show you how strong this thing is, this was this trend, right? That the channel that we were in, we broken, then it started to respect it again. Then we had a little test here, and then we came back. That's a 500-point move, right? Which is 3% in Euro Kiwi. It's quite a move, and that also shows us the strength of the Kiwi. Same can be seen in the Aussie Kiwi. There's a bit of a crossroad here around high 175s, very low 176s. If Euro continues to show a bit of weakness, I think that we are in for a test of this this level here, 173.90, 174.25. Keep an eye on this one. This is the underside of that channel. It is possible that unless risk goes really bad, in which case Euro crosses tend to be supported. But if all else equal, I think we may be in for a test here. And then it's going to be important to see what happens. Either we stay in the channel and we start to move higher again, but therefore I think we are going to need good European data, or why not? We may be in for a break. I think that's music for next week, and I'm going to at least keep a close eye on that one. You've done already the dollar China. It is a bit of a strange one today. Dollar rand. I mean, since yesterday morning, dollar rand is nearly 2.5% higher. Apparently, there's a bit of accidents going on in illegal gas mines and stuff over there, showing that the situation in South Africa is still very, very fragile. So for those who are keeping an eye on the rand, know that again there's again trouble brewing over there, or already happening, which should keep the rand very much on the back foot. If we get some weaker data without being disastrous in the US, I think I may get interested here again to try perhaps in this 1870s or so, if we see a setback this afternoon or so, or tomorrow to try and get on this trade again, because I think sooner or later this rand is still in the medium to long term. In the medium to long term, I still think the rand will have issues. What else? We are also looking in, and I've been looking at this for a while. Yeah, everybody knows at the Norwegian kroner. It's strengthening a bit. Yes, there is same as in the dollar NOK. I've got it marked on the dollar NOK, but there's a head and shoulders going on here. The neckline is pretty low though, but there's a bit of euro weakness in here. There's a bit of rebound in oil in here. There's a bit of rebound, but that's been stabilizing now in the gas market in here as well. There's two things. Either we are doing this head and shoulder, and we are going to test the neckline in the 1140s on the Euro Noki, based, I think, rather on Euro weakness than sheer Noki strength, but both can play a part if Brent plays its role. Or we are going to go and have a retest of 1175, which should, in theory, now resist on the Euro Noki. So 1175 is my my level where I'm going to get pretty interested. Dollar Noki is in a bit of the same situation. Yeah, we overshot it a little bit, but there as well we've got high 1070s, should in theory now cap. This one could be a candidate if we get mild misses in the US for a retest of the 1050. And again, if you see this 1050 zone around 1050, okay, give it down to 1047, 1048. It's an illiquid currency, so things can go really fast. But if this starts to break, then we may see some bigger moves in there as well. What's behind the move higher in oil? Well, OPEC is babbling, Ali. I don't know if you know, but they are having their meetings again, and they are trying to constantly put a bottom under the oil prices. And there's also a little bit of take going around, but really we've 71 3/4, 72.5 is a bit of a resistance on the WTI, but really, if you look at this whole zone here, and we've been talking about it, it's really one day it's the end of the world, the next day OPEC is trying to put it higher, then we've got a bit of shenanigans going on, and I think perhaps the South African situation, actually, if you start to blow up mines and stuff like that, may actually underpin energy a little bit. I don't know. It could even be related, but I think the major thing is OPEC. But you know, really, for as long as we are, if you look at these levels here, the 75, 75, 75, as long as we are below 74.5, 75, and you're above 66, whatever, we are in a big zone of consolidation here. The overall market, unless, and I'm keeping this in mind, the very big picture, unless China reopens and unless we're getting like the global economies looking good, in which case this is probably going to start to push higher again. We are in this big slide lower, right? Since 2022, we are in this big slide lower, and for as long as I said, as China is not reopening, just to take one measure point, I can see this bobbing around in this zone. I wouldn't go short on those low levels, even on a break, because I do think that the guys handling the special reserves in the US are going to show up in these zones here. They say in September, but I'm sure that if they see lower levels, they will start to be interested around here. So I wouldn't sell into a hole, but I'm actually just not trading it. And we said it in on past shows as well, right? I mean, it's tough to trade unless you really want to trade the broader range. But inside the ranges, I'm not going to get involved in it. Cedric, Aussie. Aussie to me is feeling a little bit sluggish, but we need to get back below 66.25 for a starter, and then below this zone here, 65.90, 66.05 should sorry, see support. If not, it's really bad news. Top side, my real level is above here, 67.20, and you stretch it up to 67.30, perhaps even 40. 2040, 67, 2040 is really going to be decisive for me. A break above would mean one or both of two things, is that the world is a better place because the Australian dollar is also one that is running on what commodities are doing, such as copper, and how China is behaving. Or the other thing is that something's really wrong in the United States and the dollar is starting to really falter in a decent way. In that case, we are going to see a move above the 67.2040. But for as long as we are below 67.2040, I don't have a position, but I view it as rather on the defensive, the Aussie. The one thing that could turn it around is that if Aussie Kiwi is really finding a bottom here in this 107.40 down to 107, the figure zone, it could like slide along this line and then start to go up, in which case perhaps the Aussie is starting to do better again. So that's one other measure point if you look at the Aussie. And the last one is Euro Aussie. We're on a bit of a crossroad here in the Euro Aussie around this 162.5. So for the Aussie to Ali, I've already done the Kiwi. We're on a crossroad here in the Euro Aussie. So if you get below 161.90 figure, can mean one of two things. Euro is continuing to weaken, or the Aussie is picking back up steam. If we start to move higher, well, the opposite is will be true. If we start to go back above 163.60, that would be a bit of a sign. But I think really 164.25, we can bounce back up there and then start to go back down. If you start to go below 161.90, I think then it's on its way back to much deeper levels. Kiwi, I've done it. But yeah, I think it's, as I said, 62.30 and 61.60, 61.40. And then dollar MEX. Well, dollar MEX yesterday tried it, right? It tried to break below 17. I think it's perhaps a little bit of a stop run, but the major reason for the dollar MEX being down is MEX crosses. And if you look at the revival of the bit of the revival of the euro this morning, you saw the euro MEX go back higher and the MEX yen overnight come a little bit lower. And I got the impression that there are bigger drivers for the dollar MEX today than what the dollar actually is. We still got to think about the Mexican peso as being one of the US manufacturers now that they're trying to decouple or de-risk from China. So the investors are still very much liking the Mexican peso. And I think we may have, tomorrow we are having Mexican CPI and Mexican PPI, and tonight we are having the monetary policy minutes. Banxico has told us that they would like to pause in the Mexican peso, but unless they go really dovish on those monetary policy minutes, which I did not see when the real statement came out, you have to think of it as a currency which is still granting 11%. So being short Mexico is as painful for the time being as being long yen for a long time. So it's still very hard for me to be short Mexican peso, and I don't know where this thing is really going to find bits. People were seeing stuff in the 1690s on the dollar MEX, but really, if you look at the longer term, I don't see much before 1633. Of course, there's always going to be position adjustment. If you start to go above 17.25, I think then we're going to see a bit of a higher correction. But for as long as we are below 17.25, to me that's still very negative. That's for the dollar MEX, and I'm still small short euro MEX, and I'm getting paid to be short, so I'm still very happy about this. Although, as everybody knows, I'm managing my positions relatively actively around core positions. That is, yeah, and I said we're a little bit around this trend line here, for me at least. I know some people are looking at 44, 60s, 70s, but again, as I'm saying, if you get mild misses, let's say they're expecting 225 job creation tomorrow. What do we expect today? Oh yeah, we also have the ISM services out today, which could be a mover. Let's say you get like mild misses there. I think that the equity market is really going to take it positive, and then we are going to probably see a move up into the 45s on the S&P. If you see dramatic misses, then you're probably going to have a knee-jerk reaction, but then come lower, because the market is going to be afraid that the jobs market or the services market, which was the one that is holding up everywhere, is really getting into pain territory. And I don't think that equities should, after a knee-jerk reaction, really like pain. So I can be wrong, but and if you get stronger, you're going to see the opposite, because the yields are going to rise. You're probably going to see a little bit of an algo move lower in the equities. But if you get strong economic data, I think in turn equities are going to at least hold up despite higher yields. That's it. Where can the dip go down to? 43.95, 43.75. I see as possible dip scenarios for a bounce. If you start to go below 40, if you look at the bigger picture, if you start to go below 43.30, 40, party's over. I think party's over. And that's it for me, Ryan.
Thank you very much, mate. I'll just grab the screen back quickly. Hopefully it works. You see that okay?
Yes, sir.
Yeah, cool. Right, so just to go over all the data we've got coming out. Challenger grey job cuts. Keep an eye on that one, because it has been running fairly hot of late. We know that a lot of it has been driven by the tech sector, but as you can see, compared to coming out of the COVID stuff through 2022, we're now seeing some bigger numbers coming in pretty much throughout the whole of the year. So let's see if that continues. That may start putting pressure on the jobs market. Then, as mentioned, jobless claims, it won't have an effect on the NFP, because obviously this is for last week and the NFP reporting period is a while back. But for a closer look at what's happening, or more up-to-date look at what's happening, we keep an eye on that. It did surprise to the downside, 239 last week, when it was sailing around the 260s, expecting a little bit of an uptick there. So that's one we need to keep an eye on. And then over to the ISM services, employment was already in contraction at 49.2, expects to improve a bit. If it moves into expansion again, then the market isn't going to get too worried about that. But obviously in between, we've got the ADP, which is a similar expectation to the NFP, 228K. Remember, this is only private employment, so it doesn't class government jobs and that sort of thing. So it's not a direct one-to-one thing with the NFP, but look for a big variation. That's what the market will move on. If it comes in, as Kay was saying, 150s, somewhere around there, market's not going to be too bothered. If it comes in with a big outlier number, like a plus 500 or a minus 100K, then the market is going to move and it's going to change expectations for the NFP. Later on, we do get jolts as well, but this is lagging data, but it does play into the picture of whether that ratio between openings and unemployment is potentially narrowing, whether firms are taking job offers out of windows and that sort of thing, meaning that the market may be at a point for a turn where not more jobs are being looked at or offered out. So that's that from the data. It could be a bit of a decider in terms of setting up for tomorrow's NFP. So any volatility in the numbers, you're going to see volatility in the markets. So be wary, be careful, trade safe. Thank you, K-Man, and we shall see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.